Hello, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, morning. How are we feeling this morning?
It's going to be a good day.
Well, for the last 1 week, I think we've been trying to sort of hunt for some kind of pullback in the market, but it hasn't come along. So let's see. Today's a new day.
Yeah, we start with optimism, right? I mean, no other way to do it. So let's do that. The market has been down and out for the last several trading sessions now, 8 to be precise. I'll get to that in a bit, but let's just pick up from where Wall Street left off in terms of a handoff. Not much of a handoff, frankly. It was a quiet session overnight. The S&P, it's kind of reminiscent of what happened day before yesterday. I mean, some of the stuff that we said yesterday, same time, I think can be repeated. Because, I mean, the S&P was up when we came into the session yesterday. It's down, but not material in that sense. Down about 0.3. NASDAQ is down about 0.1%. The price action in yields, that's the market, interest rates in the US and dollar is perhaps more significant. So US yields are pushing 3.93, 3.94, 3.95, right? But they're stalling a little bit. They're not taking out that 4% mark conclusively. In a way, this reminds me of what we saw perhaps in September, October 2018. Now, not drawing a direct parallel, but the fact is back then, similar kind of price action. Many thought that it'll break through, but it did not. Eventually, what happened was that as yields sort of threatened to break higher, stocks kept falling. It caused that much awaited Fed pivot. But that is back in 2018, as they say, history does not repeat, but it does sometimes rhyme a little bit. Let's hope that is the case. No indication of that, frankly, but I just wanted to make that parallel because we are seeing a doubtful kind of price action. It's not pushing through. It should by now. It's not happened. Maybe it will. Now, the dollar index is the other one. It's inched back closer to the 105 kind of levels. So it's not there yet, but it's closer. So again, there is a bit of indecision which is happening there. I looked at the Asia dollar index, which is also, I mean, you know, the dollar index, the US dollar index is made up of, I mean, disproportionately large weightage of the euro. But if you look at the Asia dollar index, that has actually posted a bullish outside, it's posted a bearish outside month, which basically means perhaps more downside levels. It broke the 100.8 level. It perhaps means more downside pressure on that particular index, which means Asian foreign exchange, Asian emerging market currencies perhaps will see pressure. If this plays out, Asian emerging market currencies will see pressure, rupee included as well. Of course, I mean, with the rupee, what matters is the 25 basis point hike that many are expecting now, the RBI to do, and that perhaps supports the currency going forward. But something to keep in mind. Now, the Nifty here has, as I said, closed lower for the 8th consecutive session. It's not happened in a long time, but it has happened before. The index closed below its 200-day moving average. For some, this is the Lakshman Rekha between being bullish and being bearish. It's a long-term average, makes a difference. The support comes in, and we put this level out yesterday as well, comes in at the 20-month moving average. We closed above it. That stands at 17,272. But I mean, you know, we closed at just 30, 40 points above that level. But that does become a bit of an important level. The SGX is indicating that we perhaps start below this level. It's a long-term moving average and has significance. Once it goes, I mean, you're basically looking at 17,000 kind of levels. I mean, supports come in around the 17,000 kind of levels. We'll see. Banks outperformed yesterday again. Nothing like what we saw day before yesterday. Bank Nifty was up 1% day before. Yesterday, it was down little, but it was down nevertheless. Resistance for the banks, the bank index comes in at the retracement level of the 5-day fall. I mean, the recent fall. So the first number is 40,509, not very far from where we are. The second is 40,790. And on the way down, 39,600 should not be violated if, I mean, the Bank Nifty has any chances, any luck of a pullback lingering around. So I think that's the setup as we start another session. As I've been saying, let the market tell you that it wants to turn around, it wants to base out. So far, despite the 7-8 days sort of fall, it's not told you that. And I think yesterday was a prime case and example. Let the market do that. You know, 50, 60, 100 points won't make a difference, but let it conclusively tell you that it perhaps has done what it needs to do on the downside and it is ready to move higher. Guys, hi.
Absolutely. I think it's prudent to stay cautious even now, right? It doesn't mean that just because the market has fallen 8 days in a row, it won't fall another 8 days. And this is a situation where it is pretty unpredictable what's happening globally. Even the SGX Nifty this morning is indicating that the start will be well in the red, down almost about 25 odd points. And put together, if you look at of course, the global handovers week, even this morning, the Dow is down about 230 points. But the month of February has been alarmingly weak for the global markets, the US markets particularly. The Dow is down 4.5% almost, the S&P 500 down 2.6%. So there's a cascading fall that we've seen globally. And even for our own markets, the selling pressure is unabated. So FI is once again sold in excess of 4,500 crores yesterday. A couple of macro data points are also on the weaker side. So you have the Q4 GDP data in India that came out yesterday. Second consecutive quarter of a slowdown. The slowdown has come in at about 4.4%. We all know the concerns, higher inflation, waning demand. So that on the sidelines is another thing to worry about. And now, in the first 2 months of this year, the market cap of BSE companies has gone down by 25 lakh crores, and that's the steepest we have ever seen in a span of 2 months. So that's the kind of selling pressure that we've seen in this market. So clearly, the sell-on rally strategy is something that is playing out. There is no change in that up until now, and it is perhaps prudent to continue to stay cautious. There's a lot of delivery-based selling that we're seeing in large Nifty companies as well. Crude is once again back closer to $84 a barrel. So there doesn't seem to be any trigger that could take the markets higher. The only thing is Asia is having a good run this morning. Hang Seng is up 450 points. That's also because now they have removed that masking, due to COVID. Now masks are not required. So that the reopening trade, I guess, is something that's playing out in the Hong Kong markets right now. But stripped of that, this is a market that the texture has become extremely weak, and there is no reason for that to change, I guess, anytime soon.
Well, that's right, Sonia. But the bears, they have an eye on history. We have never seen 4 straight negative months in the last 20 years. So this time around, they're hoping that we have already had 3 months here on the Nifty. And they're hoping that maybe, in fact, they're looking to break that jinx. So let's see whether or not they are successful. For the time being, the odds are in favor of them. But I'll tell you what, the bears are getting very, very confident and maybe a little bit overconfident as well. So maybe today, maybe tomorrow, I think a relief rally is long due. Let's look at trade setup then. Yesterday, the gross volumes, well, they were high, the FI gross volumes, but that's because of the MSCI rejig. So just take that on board. Risk reward could favor the bulls and may not be very beneficial for the bears, given that the SGX Nifty is suggesting a 50-point downtick. And if we can hold on to that 17,200 odd mark, that'll be good news. And I say this because the PCR has moved to around 0.67. The FI short positioning has moved to around 85% odd. Well, and what's been batting for the bulls in the last few days has been the Nifty Bank. Just take a look at that. The last few days, the Nifty Bank has done pretty well. It's outperformed the Nifty by close to around 2%. You like that to continue because the Nifty Bank, if that can bat for the bulls, then we can see a bit of a recovery. What are the FIs doing in the FNO market? Well, they added close to 13,000 short contracts out. Now the net short positioning is more than 1.3 lakh contracts. That's a large number. That means that the short positioning is at around 85%. On the index option side, you'll say they bought some calls. The problem is they continue to write calls very, very aggressively. And even in yesterday's trading session, the 17,400, 17,300 calls, both of them added close to around 85 lakh shares odd. So there is aggressive writing at those levels. And the 17,400 call, the rough premium would be around 50 rupees. And if you look at the 17,300 call as well, the average premium was around 140 rupees. So you plug in the numbers, you get the resistance zone. They are looking to defend the 17,450 to around 17,500. 17,200, 17,250. We bounced off the 17,250 yesterday. So that's going to be very, very important. But the Nifty Bank has been in fine form. So it needs to hold on to the recent lows. That's the Feb 1st as well as the Feb 27th lows. You like the SGX Nifty to actually open a little bit deeper, suggesting the Nifty. For the time being, it's rebounded from the lows. But if we open with a gap down, it will not be such a bad thing from a bullish perspective. That's the call.
Nigel, yesterday we had Vikash Kumar Jain. I think he put it quite nicely.
It's not over bearish.
Yeah, he said, it's lighter, but not bearish. It's not outright bearish. And sometimes you need sentiment to really get, that this is going, that kind of thing, for things to turn around. And I thought that was a kind of nice way to describe where we are at right now. But, bounces will come.
May not be sustainable, but I think maybe in the near term we're due for a bit of a bounce. But I was speaking to a couple of fund managers yesterday, and they said the next 6 months may be the best time to start studying a lot of stocks because we may move sideways, we may see a sharp correction. And that could provide the best entry opportunity from a longer term perspective. So let's see whether that plays out.
Yeah, I mean, no time to study, right? I mean, in a bull market, actually, it is crazy. If you guys remember 2000, I mean,
everything flies off the shelf.
Yeah. You know, before you start talking about a name, it's up 15-20%. So you're kind of breathless catching up, which is not the case now, which is perhaps the silver lining here. Well, before we get any further, let me quickly tell you what is lined up here over the next 30 minutes or so of the show. We'll get you updates from across the globe. Mark Matthews of Bank Julius Baer and Company will join in to discuss the global trade setup. Our research team will bring you our list of top 10 stocks to watch for the day. And we'll have Devin Choksi of KR Choksi for some fundamental stock talk.
All right, and let's get you some equity calls now. On the equity side, first up, Jonathan Garner of Morgan Stanley says that the MSCI Emerging Markets Index has corrected 8% from its late January peak, with the catalyst being a stronger US dollar and somewhat higher real rates. He says this reestablishes a significant upside of a 14% December 2023 target. He adds the China NPC meeting is due on March 4th to 5th. It is an upcoming catalyst at a time when China mobility indicators are surging back to pre-COVID levels. He adds it's noteworthy that Korea and Taiwan's corrections have been limited, with early cycle IT hardware continuing to outperform.
Okay, this is Gautam Dugar, a Motor of Financial Services, who says the market is looking weak given weak macro data and sharp slowdown on consumption. He says till the time there is a positive trigger, it will remain in a range. He adds absolute valuations are now reasonable for the Nifty, and we like tech and auto, along with select consumption stocks like M&M, ITC, Titan and Metro Brands. He adds the problem with banks is ownership and a crowded trade, which is the problem with the financial services space.
Okay, I guess, you know, what he really meant is that at banks, there is no fundamental problem. The earnings are very good. Valuations are not too demanding, but it was such a crowded trade that ownership is the only concern that he sees at the point. But let's get you some money market views and tell you what you can expect for today. For the rupee, Kunal Sudhani of Shinhan Bank says housing data in the US was mixed, though the markets mainly ignored it. Overall, softer US data, mixed geopolitical headline, challenge the dollar bulls with 105.5 as a resistance level. He further adds that upbeat European data contrasts hawkish Fed concerns as US PMI is awaited. For the dollar, INR 80 to 50 acts as a support, while 80 to 85 is a resistance.
On bonds, Neeraj Gambhir of Axis Bank weighs in. He says the 10-year benchmark bond yield traded in a range of between 7.36 and 7.44% last week. He says data continued to remain strong on the global front and our market movements mirrored global sentiment. He says weekly auction demand also remained muted on the lack of investor interest, particularly in the belly of the curve. He adds the coming week is light on data and markets should watch out for investor demand and the SDL auctions. He expects the 10-year benchmark bond yield to trade in a range of between 7.4 to 7.51%.
Well, we have a lot of stock-specific action for you, and we'll track to that in just a bit in our special Top 10 segment. We're looking at Axis Bank, Bombay Burma, Power Grid, MOIL, Federal Bank and HDFC. They are stocks on the back of positive news flow. While on the flip side, you have Delivery, Macrotech Developers, Oberoi Realty and Keystone Realtors. They are stocks that could open up in the red.